Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of Thrivewell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place. Hello, and welcome back to the podcast. Thank you so much for listening. I really appreciate you being here. In today's episode, we're going to be tackling one of the biggest questions that people have about the infinite banking concept. And that is, why in the world would I want to pay interest to borrow my own money? Well, besides tackling that question, I'm also going to share with you a little bit about policy loans, how they work, why they're so very different from bank loans, and how they let you save and spend at the same time. And by the end, you'll see why paying interest can actually work to your advantage. So let's tackle that first question. Why would I want to pay interest to access my own money? Well, when people first hear about this concept, that is a common question. The reason is because you're not borrowing your own money. You are borrowing the life insurance company's money. So it's actually following the principle of using other people's money. You may have heard of OPM. That's very common in the real estate world, where real estate investors understand that it is way better to use other people's money to fund your deals than to use your own. You're putting your own at risk, and you are not able to do something else with your own money. Well, in a similar sense, this is how this works. I can allow my dollars to sit inside this dividend-paying whole life insurance contract where they are growing, guaranteed every single day with uninterrupted compounded interest. And therefore, I can go and use the life insurance company's money to go take care of my needs in life. Go purchase that car, whatever it is that I need, while my dollars stay put, constantly growing, and it's not interrupted. And so you have to understand that the important thing here is about this compounding. And we all talk about compound interest and how wonderful it is and how it can be like the 8th wonder of the world. And supposedly that was a quote from Einstein, but we have no proof of that whatsoever. But the point is that compound interest is actually great, but it's only great if it's uninterrupted, because the minute you interrupt that growth, you're back to zero. And so we don't really have many places. In fact, to be honest with you, I don't know if there's any other place in the world that you can put your dollars and have them compound uninterrupted forever. Well, the importance of this compounding interest is illustrated. Sometimes people ask the question, would you rather have $1 million given to you today, or would you rather have a penny that would double guaranteed for 30 days? Well, the answer is actually the penny doubling every day. So think of this for a minute. You have a penny on day 1. Day 2, it turns into 2 pennies. Day 3, it turns into 4 pennies. Day 4, it turns into 8 pennies. And on until you get to the beginning of the 3rd week when it has become $163. Well, 3 weeks in, I'm still wishing I would have taken the $1 million. We get to the 4th week and we're looking at a little more than $20,000. Well, I still would rather have the $1 million. You see, the magic doesn't happen in compounding until we get to the very end. In those last 3 days, that penny has become $1.3 million and then $2.6 million. And on the 30th day, it has become $5.3 million. Now I'm glad I chose the penny, but it isn't until the very last few days, which indicates that when we have a compounding exponential curve, as it were, it's the shape of a hockey stick, right? It goes for a long time before suddenly it escalates in exponential amounts. And so the problem is that by the time we get to day 20, our car is broke down and we need a new one. And we spend that $20,000 and we're right back to zero. This is what happens in our savings account. It would happen if you borrowed against your 401k. That money stops growing. Like I said, I don't know of any other place where you can have an uninterrupted compounding curve. So that's why we prefer to use policy loans to borrow against our cash value so that our dollars can experience that compounding. So let's talk a little bit about how policy loans work and why they are so fantastic, because they truly are. So because we need money in life, right? We're always having to use our capital. So ordinarily we'd be taking it out of our savings or some other place so that it can't be put to work. Well, when you use a policy loan and your money's getting to work, this is where you're going to borrow from the life insurance company. You're not going to be using your own cash, but you are going to have some very unique terms with a policy loan. You're going to, first of all, have simple interest. So the way this works, when you borrow against your cash values and you take a loan from the life insurance company, they will have an interest rate that they will charge you. And that's because you're using their money. So you borrow their money, they will take and withhold from you the amount of interest for 1 year. So they'll hold that back so that you cannot borrow against that. So that will be held back from your amount available in your policy. They'll hold back that interest up front. And then you take your loan and you go do what you need to do with your loan. And as you begin to make payments back, the interesting thing with the policy loan is that the payments go back to principal first. So therefore, every payment you make in that year is reducing the principal. And then the interest only compounds annually. So on your anniversary date, you will see here is the interest that you owe us. And you have the opportunity to pay all of that interest so that it doesn't compound into the next year, which is what we do recommend. But you also have some really flexible repayment terms. For example, you can decide how much you're going to pay back, when you're going to pay it back, even if you're going to pay it back, because the life insurance company truly doesn't even care if you pay it back at all. So this makes for a loan that is incredibly flexible. It's also private. It doesn't go against a credit score. And you absolutely don't have to give any reason for why you're taking a loan. There is no approval process. It's just a request and you get the loan. So why in the world is the life insurance company so friendly with their terms? Well, the reason is because your loan with the life insurance company, first of all, as the owner of the policy, you sit in the number one position as being the first person to borrow against that cash value. That is your contractual right. But also, the life insurance company has a guarantee on that loan, because if you don't pay it back, they're just going to take it out of the death benefit at the end of the day. So they bear zero risk with your loans. So they can be very friendly with their terms. Another thing about the way these policy loans work, I mentioned earlier that the payment goes to principal first. So think about this. If you were to take a policy loan in the amount of, let's just say $10,000 for easy numbers, and the interest rate that the insurance company is charging you is 7%, they would take back $700 and withhold that from your loan amount available. And then they'd give you the $10,000. So in other words, the amount available to borrow against in your cash value would be reduced by $10,700. However, as you're making payments back and that principal is being reduced, let's just say that you make $3,000 worth of payments over the course of the year, then that means that you have now been paying interest on an amount lower than $10,000. Now, it can have a time value included in here, but I'm just, for simple numbers, going to say, let's say now they're going to charge you on $7,000 worth of principal at the end of the year. That would mean now you're paying 7% only on $7,000. So now the interest charge is down to $490, and they had taken from you, or they had withheld $700. So now they're going to prorate back to you $210. So essentially, it was like you took a loan and really only paid a 4.9% interest rate. Bank loans do not work this way. I don't know of any other loan on the planet where the principal is paid first and you have these kind of terms. That is just unheard of anywhere. If you hear of it, you let me know. But as a co-owner in the life insurance company, when you're working with a mutually owned life insurance company, which is what we do with the infinite banking concept, then you are also a co-owner in the life insurance company. And that means that your loan interest contributes to the company's profits. And because you're a co-owner, that means you have an interest in those profits as well. And that can turn into a dividend, which is then paid to you, the policy owner. So participating with a company that you're a co-owner in, you want to see them be profitable because then you're also going to receive profits that way as well. Now, how do you take a policy loan? It's very simple, depends on the insurance company. For some, it might mean you need to pick up the phone and request a policy loan over the phone. For other companies, and the one that I work with, you can have an electronic funds transfer form filled out with a voided check sent into them. And then from there on forward, you're able to just go online into a portal, get in there, say, I want to request a loan, put in the amount, check the last 4 digits of your checking account, make sure it's to the place that you want it to go, hit the button, and off you go. You've got your loan showing up in your bank account within 3 to 5 days. There is a little bit of a wait time there with the 3 to 5 days, but at the same time, I have to ask myself, how quickly can you usually get a loan anyways? But, we are working with a life insurance company. They are not a bank, so they're not expected to have a really quick turnaround time. Although I will say that even my credit union, sometimes I feel like I'm waiting forever for my money. So I'm not sure that it's really that much different. Now, when it comes to taking policy loans, we must remember, as Nelson Nash taught us, if you're going to become your own banker, you also need to be an honest banker. That means that if you take a policy loan, you should have a plan to pay that back. And I don't care if that's a monthly plan, if that's a plan for 6 months down the road, maybe it's a year down the road, maybe it's several years down the road. But even if it is that, I would highly recommend that you pay the interest on that loan because you can make it interest only over the course of several years. Maybe you've got a windfall coming, you're going to sell a piece of property, whatever it might be, to pay that back. That works just fine. Or maybe it's something like a car that you're going to purchase. Well, then make it back like a car payment, just like you would as if you were paying for a car loan, and pay it back to yourself, covering that interest. And then you will have all of your money back with recapturing the interest, and you have no worries there. But we do need to be sure to be an honest banker. And then finally, I want to explain, because one of the biggest things here is this understanding that I have a growing pool of capital that is getting larger and larger. When I borrow against that money, I'm borrowing a smaller amount of money out because the life insurance company will not allow you to borrow 100% of your cash value anyways. So there's a little bit of built-in protection there for you. But you're going to borrow and you're going to make some repayments back. So you're paying an interest rate, maybe it's even higher, and it is higher usually than what you're earning on your larger pile of cash values. However, you're paying interest on a reducing amount, and therefore the balance is going down while this other savings is growing. And that is what is going to create that tailwind effect that Nelson Nash talks about. So just think about this for a second, because these are some real numbers in a policy that I own. And my cash value in one of my policies is growing at a rate of $30 a day. And the loan interest for an outstanding loan, and it's a pretty significant loan, is $16 a day. So my net growth is still $14 a day. So I am still growing even though I have an outstanding loan. And this is the idea of where you can save and spend at the same time. It is financially very efficient, and it's still growing your system. So you're able to save larger amounts of money because you know you can also use those dollars to go do the things that you need to do in life, because life happens. And that's half the battle with a lot of our savings, is that we save and we're working really hard to save. And then the car breaks down. There's a medical bill, whatever it might be that comes unexpected, and our savings is depleted. But with the infinite banking concept, that never happens again. Your dollars never deplete. They're always in there growing. And that's why we like to take policy loans, and we are happy to pay interest to the life insurance company that we are also part owner with, but also know that we're still going to have that tailwind effect. So if you're interested in learning more about the infinite banking concept, you have questions, comments, please be sure to leave a comment for me. I would love to respond to them. And certainly you are more than welcome to reach out to me at banklessbydesign.com, or you can email me at tricia@banklessbydesign.com. So I hope you enjoyed this. I hope this was enlightening for you and helped answer some of those questions that kind of make it go, why would I want to do that? Well, now you know. Until next week, you have a great week, and I will see you again. Until next time, you have a great week. Thank you so much for listening. Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.